Kerry, first off, when it comes to the, Goldilocks, I guess, jobs report that we had from the US on Friday, does that give central banks, not just the Fed, but perhaps more broadly, just a bit more breathing room?
Good morning, Heidi. Yeah, there certainly was something for everyone in the jobs numbers that came out on Friday. I mean, you had good employment numbers above what was expected, but at the same time, the unemployment rate, which went up. So it did push back on the idea that you'd see the Fed sort of moving on interest rates in 2023 as the market had started to reflect it, but also provided the evidence that, the economy is improving and that you should see that sustained economic momentum continue. And that also you should see, some of those inflationary pressures start to build up in terms of wage growth and feed through into consumption in the economy. So by and large, that meant, equities that went up, but also bond markets sort of rallied and yields that have remained very low. I think the challenge for this is that as we look ahead, we do see a reflation theme that should continue, and that does mean higher bond yields. But right now you have a yield curve that's sort of flattening rather than steepening.
So we've started to see some calls at certain emerging markets, particularly here in Asia, where the vaccine rollout has been pretty patchy, will likely be hit by the Delta variant. How much of an impact is this? And are investors kind of shrugging it off and expecting that we'll just see kind of boosters that'll be able to deal with these ongoing variants?
I think the key to this is the countries that have had a successful rollout, at least a decent percentage of the population having been vaccinated. So if we contrast the experience in Europe and the UK, we have a very high vaccination rate compared to the low take-up we've seen around Asia. Of course, new variants are going to make that a little bit more difficult. The potential for restrictions to be in place longer really just re-emphasizes the need for that vaccination rate to be high to break that link. And I do think there's enough evidence out there to suggest that the focus is now on hospitalization rates rather than case numbers, because the vaccines that we do have do appear to be somewhat effective against these new variants. But until you have those high vaccination rates around countries in Asia, it's going to be something that perhaps does weigh on it and puts investors off looking at the emerging markets. And again, is why in our own investment stance, we tend to favor Europe in this case, as it is reopening and it does have those higher vaccination rates.
Now, Kerry, JPMorgan's stance contends that markets are pricing in too much of a risk from the Delta variant outbreak. You say that you still have good upside for the growth outlook. Inflation also has been rising. What does that mean for the trajectory for yields? Where do you see the U.S. 10-year in the next half? And what does that mean for exposure to this theme?
Yeah, we certainly do think that there's a good economic momentum around the world. I mean, the drivers of that growth are changing. It's rotating away from China and the US and more towards Europe as you're seeing that recovery ongoing. And later it will feed into emerging markets and the rebound there as those vaccinations do start to pick up and become more prevalent. I think that's the key. There are vaccines out there that are effective, and so they should take longer to come through and actually improve that. And that does mean we should see inflation and bond yields move higher. We think the US 10-year is going to probably get towards 2%, maybe a little bit above that this year. So 50 basis points from where we are today. And that does suggest being that sort of short towards duration in this environment and looking towards parts of the fixed income market that are going to perform better in that environment. And that's sort of credit, particularly around high yield and loans, where you are picking up a bit more carry than you are in the other parts of the market, and also are going to perform well as the economy improves.
Now, Kerry, while we have seen yields stay stagnant, that has stalled the rotation, now seeing growth outperform value. But if the U.S. 10-year does breach 2%, where are you seeing opportunities within the growth space? Of value in growth has been a specific area of interest for many of our guests.
Yeah, I think it is the case that people are looking towards, the stocks that have been very, very highly valued and moving back into them as those valuations change and that reflation trade hasn't panned out as expected. For us, I think you'll see that start to reverse and you will see the more cyclical parts of the market start to perform again. Consumption is still very good around the world. Consumer confidence numbers out of Europe and the US are still very good. You are seeing business capex pick up. That all does point towards strength in those cyclical parts of the market. And again, those are the relatively more attractive parts when we look at, say, price to earnings ratios. And while there has been an improvement in value, that gap between growth and value is still some margin. And so I think there's further to run on that value value trade in that cyclical part of the market. I think in the long term, however, when those growthier stocks, particularly those ones that have that very long secular theme, do come down in valuations and some of the heat comes out of those valuations, investors will turn back towards them as they start thinking about growth at a reasonable price and realize those are the things that are going to drive returns in portfolios over the medium term.
Kerry?